Welcome to a special edition of Guide to the Global Economy. I'm Josh Lipsky, Chair of International Economics, and today is our prediction episode for 2026. It's a little bit of cheating because we're already a few weeks into the year, but I think it's still fair to forecast at least the next 11 months of what we expect to happen. So we at the GeoEconomics Center have our views. We like to be out of consensus on the future and try to do things that are a little contrarian. For example, last year we predicted that Trump would issue far more tariffs than anyone thought. I think that prediction largely panned out over the course of 25. This year, we are making the same prediction. We think Trump is going to double down on tariffs in 2026, even though most of Wall Street disagrees with us and thinks he is going to ease off tariffs. That's just one of the many ways where our predictions differ from Wall Street's. That's what makes it fun. That's why my colleague Sophia Busch and I brought in the chief economist of Goldman Sachs, Jan Hatzius, to debate, discuss, and outline what's going to happen in 2026 and where we disagree on AI, China's economy, and the outlook for the global economy. Here's Jan. We're going to jump into the prediction segment of the Guide to the Global Economy podcast, and we could not have a better guest than Jan Hatzius, chief economist for Goldman Sachs. Jan, this is a new idea we're trying here at the GeoEconomics Center where we're going to test out predictions because we really believe in breaking down the walls between Wall Street and Washington. And we think there's a lot of disconnect between what finance believes and what policymakers believe in Washington. 2025 bore that out on the tariff front. And we're trying to get ahead of the curve and think through where the next fault lines might be and where Washington and Wall Street are talking past each other. So I'm going to toss it to my colleague, Sophia Busch, managing editor of the Guide, to give you one of our predictions and get your feedback.
So one of the things that we were looking at as a team this year is, everyone's talking about the U.S. potential AI bubble and those risks, but we kind of wanted to look at China, and we saw real increases in the stock valuation for SMIC, Alibaba, Tencent over the past year. And we were kind of wondering if maybe those stocks could even be an alternative to the U.S. Magnificent Seven. But yeah, wondering what you were thinking about that, if you were pricing in any kind of China AI bubble into your outlooks, or maybe it's not even that big of a deal to their economy.
I think it's a big deal to their economy. I mean, in terms of the individual stocks, I don't have a ton of insight there. I do think that China is continuously upgrading its ability to make manufactured goods and increasingly also competing with the US in the most advanced parts of the technology industry, including AI. So I do think that is real. And I think it's a support for the Chinese economy, and one reason why our forecast is towards the optimistic end of the spectrum. We're looking for close to 5%, 4.8% growth, despite a lot of challenges still in China on the domestic side as far as domestic demand and property is concerned.
Their reliance on technology, how you think about the trade détente now and the semiconductor agreement and H200s, how do you think about this in terms of the boost to their growth in 2026?
Well, I think clearly they are able to use their strengths and their leverage to get what they want to some degree in global negotiations. And that's been true even vis-a-vis the US in 2025. China managed to withstand the sharp increases in U.S. tariffs and, ultimately persuade the administration to step back. And I would expect China to continue to do that in negotiations with other countries as well. I mean, they're throwing their weight around for sure in terms of control over critical minerals and rare earths. We're seeing it vis-a-vis Japan at the moment. We'll see how that spat plays out, but I do think China is formidable when it comes to anything related to global goods trade and increasingly technology as well.
Let me ask you, Jan, What is your most out of consensus forecast? We always are trying to push the envelope here with the guide. So we're trying to show people things they haven't seen. China's tech bubble, while we're all focused on the US tech bubble, as we've talked about here. But from your perspective, what is you think at Goldman, your forecast that is so different from your colleagues that sometimes you pause and say, I don't know if I'm right about that?
I often think about that. Of course, you always try to be out of consensus, but out of consensus means you're more visible, and that increases the benefit of being right, but also increases the cost of being wrong. And you always need to think about both sides of that. What is our most out of consensus view? I would say it's the combination of an above consensus forecast on growth. We're at 2.7% annual average for the US, and a below consensus forecast on core inflation. We have core PCE inflation go to just 2.1% by the end of this year. What ties those two things together is a pretty optimistic view on productivity, which means sturdy growth doesn't translate into significant labor market tightening, and the belief that the tariff boost to inflation, which was important, not quite as big as expected, but nevertheless important in 2025, that comes out of the numbers as we go through this year and as we anniversary the biggest increases in tariff rates.
Well, that's one we can easily measure and ask you to come back and tell us how it's going as we go through the course of the year. I know, Sophia, do you want to add anything yet on trade?
I mean, I'd be curious to know why you see the inflation impact from tariffs sort of diminishing.
Basically, because the tariff impact on inflation is a price level effect. So as you go from, a 2% average US tariff rate to, say, a 10 or 12% average US tariff rate, you see an add to the price level. But then once you stay at that 10 or 12%, or maybe even move down a little bit, the price level impact remains, but the inflation impact basically ends when you anniversary the increase. It's, this is very well known in areas like value-added tax hikes in Europe or consumption tax hikes in Japan. We've seen this over and over and over again, that you get a jump in the inflation rate when those tax hikes occur, but 12 months later, that jump reverses. And that dynamic is what I think we're going to see in the US.
So, Jan, let me ask you this kind of classic Wall Street, Washington question in the spirit of this segment we're doing, which is there anything that Washington can do that would scare Wall Street? I'm thinking in the context of what's happened with Venezuela and the markets looking past that. It just seems to me, at least, the markets will look past almost anything, but I'm sure there's a limit to that theory.
In Europe, if I look at Ukraine and Russia, I mean, that's still an important issue. It's simmered down. It had very substantial macro effects, though. If you go into, you go back to 2022 and the energy crisis that resulted in Western Europe, the really enormous surge in energy costs, which I think has contributed to the deindustrialization of European economies, the weakness in the chemical industry in Germany, for example. And it's also contributed to financial asset moves. The freezing of the Russian foreign exchange reserves, I think, was probably the biggest impetus for the surge in gold prices as central banks in countries that are not on friendly terms with the US diversified away from treasuries into gold. So these geopolitical developments can have important effects. And I do think the relationship between Russia and Western Europe or Central and Eastern Europe, that is still very, very important. And I don't think we should kid ourselves that just because more recently, the economic effects have been smaller and in a more positive direction, that means we're not vulnerable there. I think we very much are vulnerable.
Yeah, one thing we've said at the center is markets sometimes might mistake resilience for immunity, and I wonder if we'll test that in 26 or not.
I guess we'll find out, but it's a good way to put it.
That was Jan Hatzius on his predictions for the global economy in 2026. If you want to see more of our predictions, you can visit our website at the Atlantic Council. And if you want to hear more of our podcast, subscribe wherever you find podcasts. Thanks, everyone, for listening.